Hey guys, welcome back to another episode. In this video, we are going to show you the advance and the real secret of how to trade the financial market using the RSI indicator. This will help to increase your trading skill and as well improve your trading strategy so that you will consistently win most of your trades. So here is exactly what we will be covering in this video. As always, to help us in creating content like this, please click the like button, subscribe, and turn on the notification bell to get notified whenever we upload a new video. Now, let's get right into the video. The RSI is an oscillating indicator that measures asset momentum. That is both the speed and size of price changes, which in turn helps to identify whether an asset is overbought or oversold. Using this information could help you determine potential entry and exit trading points. With access to this indicators tab, here on TradingView, I will leave the link in the description below. Click on it and type RSI. This one right here is what you will click. Now, RSI has a default setting of 14 periods, meaning that it measures current price action in relation to the previous 14-period candlesticks, depending on the time frame you are operating on. Hence the name relative strength. RSI has a price range of 0 to 100, which is divided into regions of 30, known as the oversold region, 50, the center of the RSI, and 70, which is the overbought region. Now the question you might be asking is, how do we use the RSI to spot trade entries and exit signals? The answer is in the next section of the video, which is the conventional application of the RSI. So let's get right into it. The conventional way to use the RSI indicator to identify potential trend changes or trend direction is basically watching out for this RSI line to cross below this overbought region, represented by this 70 line. When this happens, it shows that buyers in the market have lost momentum, and sellers are stepping in to take control of the market, and the price later moved downwards. Now, when the RSI line crosses above this oversold region, represented by this 30 line, it shows that sellers in the market has sold enough of their asset and are losing control of the market, while more buyers in the market are stepping in to take control of the market, which caused the price to move upwards, forming an uptrend. For example, this chart shows a clear moving uptrend. As the price was moving up, the RSI was as well moving up. As the RSI got to this overbought line, it reversed, but there was no short trade here because the RSI made a higher low and the price and the RSI continued up. The RSI later crossed above this 70 line and entered the overbought region, which later crossed back below the 70 line, but this time the RSI went downwards, forming a lower low because of more sellers coming into the market, and the price started a downward movement, and this then presented a short trade opportunity. Here is another example. As the price came down, you could have entered a long trade here because as the price reached this oversold region, it tried reversing, but there was no trend change confirmation because the buyers in the market showed some weakness after the reversal and the price continued down. Once the price came back to this 30 line and crossed above it, you have the price making a higher low, which then presented a long trade entry opportunity. You can see that the price and the RSI continued up with much bullish momentum, making this a high-quality trade. Here is another example. As the price moved up making a new high, the RSI entered overbought. Then, when the RSI crossed below this 70 line, the RSI signal line and the price consolidated for a few candles before forming this resistance price level. Notice that the RSI didn't cross below this 50 line. Then price broke through the resistance and made a new high, which later reversed. When the price broke below this resistance level and the RSI crossed below this 50 line, you will take a trade entry short. It is important to know that when the RSI is above this 50 line, it represents buyers' dominance in the market, and when it is below the 50 line, it shows sellers' dominance in the market. Now that you've learned how traders might use RSI to determine trading signals, let's discuss how the indicator can be used to spot potential trend reversals. Generally, an RSI divergence means that the RSI indicator is moving in the opposite direction compared to the price. As a result, while the price is moving, the RSI is telling us in advance to anticipate a change in the direction of the price. RSI divergence provides a more reliable signal than the overbought and oversold signals provided by the RSI indicator. The divergence, however, happens less frequently. But spotting and trading divergence on RSI is one of the most powerful ways traders make huge profits from the market. We have got two forms of divergence: the positive divergence, which is bullish, and the negative divergence, which is bearish. Both the two forms are subdivided into tight divergence and wide divergence. Let's start with positive and tight divergence. A positive tight divergence starts with a downtrend before the divergence formation because the price made a lower low and the RSI made a higher low, causing the price to reverse. This is more visible with a line chart, so let's change this chart to a line chart. Now you can see that the price made a lower low and the RSI made a higher low, forming the divergence. This is an early signal that more buyers are entering the market, and the price later reversed to the upside direction. Let's switch back to the candlestick chart. Now the positive wide divergence. A positive wide divergence also starts with a downtrend before the divergence formation because the price formed a lower low and the RSI formed a higher low, which later caused the price to reverse and move upwards. In this kind of divergence, you can clearly see the swings in price action and the RSI, even without using the line chart. A positive divergence is a bullish signal that tells you that the market is about to move upwards. Now the negative divergence. Let's start with tight divergence. Negative tight divergence starts with an uptrend. Here the RSI formed this first divergence, but the price later continued up. As it reached this level, it formed this second divergence and the price reversed. This divergence becomes more visible to the eye on the line chart. So let's change this chart to a line chart to further confirm the divergence. Now you can see the divergence that formed on this line chart because the price made a higher high and RSI made a lower high, which shows that more sellers have entered the market. Then the price reversed and started a downward movement. Let's switch back to the candlestick chart. Now the negative wide divergence. Negative wide divergence starts with an uptrend before the divergence formation because the price made a higher high and the RSI made a lower high, which later caused the price to move downwards with a heavy bearish momentum, making this a high-quality trade. Trading RSI divergence this way is great, but if you have divergence forming at key levels, it will help to increase the quality of the trade and put more confirmation to your directional bias. So in the next section, we will try combining divergence with these key levels. Here you can see that as the price came up, it hit and reversed, giving you a key level of resistance. Then as the price approaches this level again, the RSI formed this divergence, which was an early sign that more sellers are entering the market, which later caused the price to reverse. To further confirm the reversal, you will put a trend line like this, forming this rising wedge. Then after the price broke below the trend line, you will take a breakout entry short, because the break below the wedge pattern or the trend line is the price action psychology that confirmed the RSI divergence and price continuation to the downside. Now the question almost all the traders get asked is, which is the best divergence? The RSI divergence or the MACD divergence? Let's use the price chart to show the divergence of both indicators. Here is an example of the divergence shown by the two indicators. The chart on the left shows the MACD divergence, and on the right is the RSI divergence of the same asset. You can see that when the price came down, it hit and reversed. Then as it came back down, it made a lower low. Notice that the two indicators made a higher low, which is a divergence and an early sign that the market is gaining more buyers and price direction is about to change. This later caused the price to reverse. Then after the reversal, you had no confirmation of where to enter a trade, but you had your trend line that runs through the highs of the move. When the price breaks above the trend line, you will take a breakout entry long. More secure traders will wait for the price to break above this key level before opening a long position, as it will help to further confirm their directional bias. Using the divergence of any indicator all depends on your overall strategy, as all of them work the same and perfectly fine. But some traders prefer to use the divergence of one indicator over another indicator, which also boils down to their strategy. It is important to know that both of these indicators sometimes gives a false signal. That is why it is always good to combine divergence with price action, as it will help you to have more quality trade entries. Now let's move on to the strategy section. Here you can see that the price moved up making higher highs before forming this negative wide divergence. Notice that the price didn't reverse immediately. Instead, it formed this second tight divergence and reversed. To make the divergence more visible, let's switch to the line chart. Now you can see that the price formed this tight divergence before reversing. Let's switch back to the candlestick chart. To further confirm the reversal, you will put a trend line like this, and after the price broke below the trend line, you will take a breakout entry short. Here is another example. As the price came up, it hit and reversed, giving you a key resistance level. As it came back up, it formed this price range before it continued down. As the price approaches this level again, the RSI formed this negative wide divergence, which was an early signal that the price direction is about to change. Finally, you had these long wick candles forming and rejecting the resistance, and the price reversed. To confirm the reversal, you will put a trend line like this. After the price broke below the trend line, you will take a breakout entry short. All of this confirmation you had made this trade a high-quality trade. To help us in creating content like this, please click the like button for the YouTube algorithm. Subscribe and turn on the notification bell to get notified whenever we upload a new video. Let's grow the channel together.